Last week we started the discussion on national accounts. There we discussed first the models, basic model, closed economy without government, then closed economy with government, open economy model in detail with all the markets, all the market forces, all the transactions. Then we explain the key accounts, macroeconomic accounts that can be used to explain the economic performance. Under this each account, you have the indicators. National accounts, government budget, BOP, monetary survey. These are the accounts. Under each account, you have the indicators. First indicator is the national accounts. National accounts, the calculation we discussed. We said the approaches, uses of calculation, purpose of calculation. Calculating GDP, we can calculate economic growth, per capita income, GDP deflator, ratios, savings ratio, like that. A number of the objectives, the purposes. And again, budget deficit, current account, public debt. Also, we need GDP to express budget deficit as a percentage of GDP. The BOP, current account deficit, as a percentage of GDP. Public debt as a percentage of GDP. Now, at present, ours the public debt has exceeded the 100% of GDP, around 101%, right? Then some pictorial presentation we discussed. Then there we discuss very important observations. That is, if you consider last 20 years, 40 years period, the sector, agriculture sector contribution is falling as a percentage of GDP, falling. Then industrial sector percentage is growing, increasing, and the services sector percentage is rising. That is some stylized facts about any economy, any developing economy, right? Any economy that is over time developed, right? Then when agriculture sector contribution decreases, employment engaged in this sector, employed in this sector also falls. Then the calculation. We have discussed three approaches: production, expenditure, and income approach. Last week we finished the production approach. Three concepts. You can calculate GDP using either production side, or the expenditure side, or the income side. Then, but theoretically we said the values should be the same. If you use the using production approach, if you calculate GDP and we get the answer of 1,000, even GDP E should be 1,000, GDP I2 should be 1,000, theoretically. But practically it won't happen. We said, we discussed some of the reasons: existence of the illegal or the underground or the informal economic activities. They are not reported to the central bank. They are not reported to the Department of Census and Statistics. But people earn income using those activities. They spend. Expenditure estimate is generally higher than the income approach or the production approach. Then we discuss definition, value added. Value added concept is used to avoid double counting. And the concept, sorry, difference between domestic and national. Domestic GDP, just domestic product, we include irrespective of the ownership of activities, whether the activities, economic activities, companies owned by China or the Korea or Japan or India. We don't consider, in our GDP, we include those activities, value added GDP. But in the case of national estimate, we make some adjustments. Net factor income from abroad, factor income, profit going out, profit coming in, like that, we make adjustments. Then we consider the residents of the country, so GNP. Then GNP equal GDP plus some factor, net factor income from abroad, net primary income from rest of the world. That is, you can directly get that number from the balance of payment statistics in the annual report. Then we discuss GNP. In Sri Lankan case, there are about 48 subsectors. Value added is calculated, 48 subsectors. Then we discuss the difference between real and nominal GDP. We discuss GDP real, GDP nominal. We said real GDP reflects only the production change. Real GDP, if real GDP value increases, that means only it reflects the production change in the economy. But if nominal GDP value increases, that means both the production change and the price change. In the real GDP, we stop, we freeze the price change. We consider only the production change. How do you freeze the price change? We take the base year, prices prevail in a particular year, then we calculate. I use a simple example using coconut production. We try to understand the difference between nominal and the real. Then the concepts. I think last week we discussed the growth rate, how to calculate GDP at market prices if we know. These are real values. Real GDP, percentage increase in GDP is the economic growth. Now, from 2018, 19, 20, even 21, our economic growth rate will be negative, mainly due to the pandemic, corona pandemic. So, it will be negative. That's a very serious issue. It's the issue for all the other countries in the world, US, UK, Thailand, regional countries. But from some countries, 21 onward, they have reported there will be forecasted, there will be positive growth rate in the economy, right? Okay. Then the per capita income. Per capita income we didn't calculate. How do you calculate per capita income? Now we get the GDP market price. This is not the real value, nominal value, nominal GDP. Or GNP also nominal GDP. 2016, 11,839 billion, 11,506 billion. If in terms of GNP also we can calculate. We can calculate either per capita income using GDP or the per capita income using GNP. Please, I believe you can hear me. You can hear me and see the presentation. If you can't see, please tell me. Please tell me. Right? Otherwise, I don't have any way to the check monitor. Right? Then how do you calculate the per capita income? Let's say the GDP per capita income. For example, GDP per capita income in 2016, 3835. Last week I gave the numbers 70, 18, 19, 20. It is going down. It is going down. I can tell you the 2018, 19. For the Central Bank annual report, key economic indicator, GDP at per capita GDP at market price, at current market price, 2016 it was 3885, 3886, 8835. Now 2017 4077 increase. 2018 4057 decrease. 2019 3852 decrease. Then 2020 3682 further drop per capita income. So value of goods and services produced in the economy may be rising, but when you calculate per capita income, it is falling. Why? What are the reasons? See this. Then how do you calculate? We take the GDP at market price from the Central Bank annual report, table number 1. Table number 1, appendix table 1. Both numbers are there, GDP at market price. Then mid-year population. Now mid-year population in thousands. In Sri Lankan case, 2016, now mid-year population was 21.2 million or 21,203,000, right, in thousands, right. Then average annual exchange rate 145.60 rupees and dollar. Using these numbers, we can calculate per capita income. How do you calculate? GDP market price we divided that by the mid-year population and divided by the, when you divide by the mid-year population, you get rupee value. Then the dollar, to make transform that into, convert that into dollars, we divide the rupee value by the exchange rate. Then you can get the number. GDP at market price divided by mid-year population, then divided by the exchange rate. You get the GDP per capita income. I can do the one number, GDP at market price. I'll write down 2016. GDP at market of 11,839. Mid-year population 21,203. Exchange rate and then 4560. GNP 7506. Right, okay. Right. Now you can see the calculation. Can you see the board? Hello? Can you see the board?
Yes, sir.
Yeah, you can see, no? Yeah, Lalani? Can you see the board?
Can see, sir.
Can. Yes, okay. Now these are the numbers for 2016 from the presentation, right? GDP 11,839, 2016. 11,506 GNP, population 21,203 thousands. This is in thousands. And this is in billions. Billions. Now we have to do some unit change. This is in billion. 11, 8. Now we have to go to calculate per capita income. Per capita GDP equals GDP 11,839. But this is in billions. You have to make the millions. You put 3 zeros. Millions. This is in millions. Divided by, this is population 21,203 thousands. Thousands, right? Thousands. Then you have to make this millions. Yes. 21.203 million, both in million. Million, right? Then the exchange rate into 145.60. That's how we calculate, right? 11,839 billion, make that million rupees. Divided by 21,203 million, that is 1,000 millions. Then 145.60 is the exchange rate. Let's calculate this. Calculate this. If you have the calculator, you can check that. And do that. 11,839 000 divided by 21.203 equals, then divided by 145.60, 145.60 equal. Sorry, I'm sorry. 11,839 000 divided by 21.203 equals, divided by 145.60 equals 3834 $0.920. Dollars. 3834.920. Roughly $3835. Per capita income, per person income, right? That's how we calculate. Even for GNP, you can calculate. GNP also you can calculate. Take the GNP value, billion, put 3 zeros, make it millions, divided by the population in millions and the exchange rate. Then you can get the GNP, NP at market price, per capita income at market price, right? Please work out that. That's an homework exercise. Other years also I want to calculate per capita income with the per person, average person in Sri Lanka in 2016 was getting dollars annually per year, $3835. $3835 average person. That doesn't mean each and every person is getting 3835 average. There are people below this average. There are people above the average. Very rich people, right? Maybe if you take first 10% of the population, richest 10%, their per capita income could be huge. Lowest 10% per capita income will be very low. But we are talking about the average, right? Okay. Right. Okay. Then that is the per capita income. You can calculate GDP per capita income or GNP per capita income in other years also. If you can't see me or if you can't see the presentation, please tell me. Then the GNP also, 2016, take 11506, put 3 zeros. 11506 is coming from the Central Bank annual report. Put 3 zeros, make it millions, divided by mid-year population, 21,203 in thousands now. Then 21.203 millions. Then again divided by $145.60. Now we can say, now you can see this GDP, there's a drop even for 15 to 16, 3843, 3835. There's a drop in $8 drop. Why is that? What is the reason? What is the reason? Now you can guess some reason. From 2014 to 15, GDP 3821 to 3843 increase. Now you can see during that period what is the exchange rate depreciation, 130 to 136, 131 to 136, and let's say 130 to 135, only $5 depreciation. You divide that by, but the 15 to 16, 135 to 145, $10 depreciation, huge depreciation. Depreciation rate is high. When you divide by the denominator, you get very high number. Mathematically speaking, high number, your dollar value decreases. So one of the reasons is increase in the denominator, division, exchange rate, increase in exchange rate, depreciation of exchange rate. Compared to large depreciation of exchange rate is one of the reasons. In Sri Lankan case, 2018 to 19, huge drop in exchange rate, depreciation. That is one reason. Other reason is the GDP, the numerator. Numerator also not growing at fast. Numerator, there's a drop. GDP falling. Denominator, you are dividing by higher number. That's why GDP's per capita income is falling. 3835, the 18, 19, 20. Continuously falls, right? Please read the Central Bank annual report. If you have the 2020 annual report, the You have the key economic indicators. Key economic indicators, just to, before the beginning of this economic report, chapter 1, before the chapter 1, you have the key economic indicators. You can see the depreciation rates also. Depreciation rate also, average annual exchange rate, for example, 2016, 145, 2017, 152, 2018, 162, 2019, 178, depreciation increasing. Even GDP also falling. Because of that, per capita income falling, decreasing. Right? Okay, next one. GDP deflator. Now that is, GDP deflator is calculated using GDP at market price value. That is table 1, appendix table 1, 11839. Same as the earlier value 11839, GDP at market price. NP at market price, the NP at market price, that's also GDP at market price. GDP at market price, GDP. Sorry. That is the constant market price, real. Table 2, that is real value, right? Okay, 9012. Both should be the same. GDP. Please change that. GNP, GDP at market price. GDP at market price, real. There you can see GDP at market price 9012. Next table, GDP at market price, nominal value 11839. So combine these two, 11839, 9012. So you have to change this to GDP. Then first line row is coming from the table 1, nominal value, nominal GDP. Second line, GDP at market price, coming from table 2, appendix table 2, annual report, they are real values. Then how do you calculate the GDP deflator? You divide 11839 divided by 9012, 1.313. 2015, nominal value 10952 divided by real value 8634, 1.2684. Nominal divided by real. Okay. First you calculate GDP deflator. 1.225, 1.2581, 1.2684, 1.3137. These are the ratio. Then percentage increase in GDP deflator. You can calculate percentage increase between these two values. 1225 to 1.25, that is 2.9. 12581 to 1.2684, 0.8. 1.2684 to 1.3, so 3.6. What is that? Percentage increase in deflator is called inflation rate. It's a measure of inflation rate. Inflation rate in Sri Lanka officially measured using Colombo Consumer Price Index, CCPI or GCPI, New Colombo Consumer Price Index, New Consumer Price Index, CPI. That is estimated by Census and Statistics Department, right? When you calculate this CCPI or this Colombo Consumer Price Index and CPI, they have different markets. They collect every week or every month, collect prices of these goods and services. It's a basket of goods and services. Prices. Then there's a formula, mathematical formula course. We are not talking about deflator. We are talking about this CCPI. They have formula called Laspier's formula, mathematical formula. You using those price values, basket values. Average consumer consumption basket is defined, right? So you calculate prices of some prices increasing, some are decreasing, some are constant. Then what will happen? Using the Laspier's formula, Census and Statistics Department calculate the price index or the inflation rate can be calculated. Price index, percentage increase in the inflation. Nothing to do with this slide. Now, officially we calculate, CCPI is calculated by the Census and Statistics Department. Then percentage increase is the inflation. That calculation is a direct calculation, explicit calculation. There's a methodology to calculate the inflation rate. Using that formula, they calculate. But this GDP deflator is a indirectly you can get a measurement of inflation rate. Understand? So the GDP deflator also a measure of percentage increase, also a measure of inflation. CCPI is officially recognized index. They use perfect methodology in calculating the inflation. But this also, GDP deflator also can be used, calculate inflation rate. Understand? For example, now what will happen? What do you think about the inflation rate for this month or next month? What will happen? Gas price increased by around 1,200. Then the milk powder increases, cement price increases. Right? So some of the other goods and services, chocolates and other the Swiss roll, chocolate roll, their prices also, most of the items increase. Then what will happen? Generally, we can expect if those items are in that basket, we can explain higher price rate of increase in prices. So you can predict this year, this month, inflation rate would be very high. Next month, there will be full impact. On the full impact is coming next month. No, now this is October. Mid-October, they revise these the prices. Then up to 14th, 15th, you had lower prices. After that, higher prices. Consumers are facing higher prices. Then full impact will be on the next month. So, in other words, we can expect higher price growth, high inflation rate, consumer price growth in this way. When price increases, cost of living increases. When cost of living increases, people living standard decreases. People have problem, right? If your average household want 22,000 rupees per month, because of this price revision, maybe it will increase to around 30,000 rupees or 28,000 rupees. Additional, you have to earn additional money, additional sums of money. Inflation rate is so therefore cost of living increases, living standard falls, prices. But now people talking about inflation, prices are rising. But the thing is, when price increases, if your wages, earnings also increases at the same rate, no issue. But the thing is, government sector, private sector, company not in a position to increase the wages. Maybe informal sector people adjust their wages. Masons, carpenters, coconut pluckers, they might say things are expensive, we need higher rate to pluck coconut. Maybe if they charge 200 rupees per the tree, then they might say coconut tree, then they might say, okay, now we need 300 rupees. They can adjust their earnings so that to match with the price increases. But private sector, government sector, the wage increases, it's not easy. They need budget, higher budget. Then people only have to pay the higher prices from this side, no wages increases. Therefore, their real income falls. The living standard decreases, cost of living increases. Right? Okay. Now this deflator, I said deflator, percentage increase in deflator also, measure of inflation. First, you calculate GDP deflator as a ratio of current and constant prices. Then calculate the percentage change. That is the measure of inflation, right? Okay. Now we'll go to this second approach. What is the expenditure approach? We said there are three approaches, no? Production approach, we completed, discussed concepts. What is GNP, what is GDP, what is NNP, what is real GDP, what is nominal GDP, how do you calculate growth rate, how do you calculate per capita income, how do you calculate deflator, inflation rate, like that. Now the second approach is expenditure approach. Expenditure approach is different. Expenditure approach. Now, we said last week, if you take a household, particular period, year, 1 year period. So they have so many activities. Consumption, activity, then they work, some people work, some mother and father work, maybe father is working, one brother is working, you have some FDs, some savings account, sometimes you may have some treasury bills, right? So many activities are going on, schooling, medical expenses, fuel and light, the electricity charges, then activities. Value of the activities, household activity can be calculated using production side. Other side is expenditure side. How much, what is the consumption, right? Then you can calculate consumption of durables, food items, non-food items, medical expenditure, like that. If the investment, your household doesn't have any investment, no government, no X minus M. Now, if you generalize this to the whole economy, open economy with government, government is there, import-export trade, X minus M, XM is also there. Then what are the all expenditure items? Total consumption expenditure. Consumption expenditure by the government and the consumption expenditure by the household or the private sector. Investment expenditure of the government sector. The expenditure, investment, consumption expenditure. Then X, exports, M, imports. X minus M. That is the GDPE formula. C plus, I plus, G plus, X minus M. All the expenditure. Consumption expenditure of the private sector, investment expenditure of the private sector, government consumption and investment expenditure, exports value, imports value. Financial flows. Then, if you add all these C plus, I plus, G plus, X minus M, you get GDPE, expenditure value, GDP. Theoretically, it should be some equal to the production value, GDP, P. Now, this GDPE will increase if we can increase consumption. Country's GDP increases. If you can increase investment, country's GDP increases. If the government can increase the expenditure, country's GDP increases. The net export, X minus M is called net export. If the net export increases, GDP increases. Understand? Then you can decide the policies to do these changes. If you want to increase consumption, how do you increase consumption? If savings rate, interest rate decreases, people will not save, people will use that money for consumption. Right? If the government reduce taxes, income taxes, then people have more money, they will increase consumption. Tax policy, interest rate policy. Tax policy, interest rate policy can be used to change consumption. Investment. If you want to increase investment, who invest? Private sector. Theoretically, private sector investment decision depends on interest rate in the economy. The private sector rarely use their own funds. No, they get money from the order facilities, loans, credit facilities from the banks. If the interest rate, and the investment inversely related. If interest rate increases, investment will go down. If you want to increase investment, you have to cut down the interest rate. Then if you want to increase investment, then you can, if you can increase investment, you can increase GDP. Reduce the interest rate. So the interest rate policy going down. Interest rate is going down, investment will increase, GDP will increase. Government expenditure does not depend on tax policy or the interest rate policy. It's a government's the monopoly. The government says this year we are going to increase expenditure on education, health, security. Then you want to buy Pfizer, another third. Then now people are talking about the third booster. That is third vaccination for over 60 years so age old people. Then Pfizer, they might get the Pfizer, right? So you have to buy those vaccines. Right? Government will have to increase more money to the high health sector. Again, government say, okay, this year we are going to increase health expenditure, so many billion. Now, the Honorable Finance Minister presented estimated expenditure, budget values, estimated. They are called appropriated, the very rough estimate, because the budget will be presented in, actual budget will be presented in November 12th. Before that, you have to get the parliamentary approval, the expenditures. Then he presented these values. Now this year, the budget government expenditure will go down by 33 billion. They are going to cut the expenditure by 33 billion. Now these rough estimates, numbers were presented to the parliament. Information. Then they are going to say more allocation for the health, security purposes, right? Agriculture. Like that, they say indication, but real numbers we can get in November. Usually our budget day is November 6th. Now this year they have postponed that to November 12th, right? They will need more time. Then to increase GDP, increase C. Increase GDP, increase investment, private investment. Increase GDP, increase government expenditure, health expenditure, then the expenditure on transportation, the highways or the motorways, other the small projects, rural projects, like that, investment, and the consumption. If the government increase the salaries and wages of the teachers. Now this teacher strike is going on. Their main demand is there are some accumulated the arrears. So they want teachers to be paid the arrears. Then government, there are negotiations are going on. Government has given one proposal. Then the teacher unions, they have not agreed. Now the problem will be dragging on. Right? We are not quite sure what will happen. Will they be able to arrive at a solution, right? Government say we are going to staggered basis. We are going to grant your arrears, pay your arrears in 3 installments, but the union's demand is 1 installment. Pay that. So that's a conflict, right? So therefore, if government increase the government employees' salaries, wages, and expenditure, government expenditure increases. So much of billion, GDP increases. Okay. Last item is change in X minus M. This is called net export. Export, M, imports. Net exports, take down. That is net export. When net exports increase, if you can increase exports and decrease imports, you can increase the GDP. Right? Now, what is happening here is that now because of the pandemic situation, exports are falling. Government suppress imports. Government put restrictions for the non-essential imports. Car importers, you can't import cars, right? Then the non-essential imports suppress. Then the export market is falling. No exports. Therefore, our GDP has a tendency to GDP to decrease. These are the reasons, right? Okay. Now, investment and savings. We said investment and savings. What is the relationship between investment and saving? Who saves? Who invests? Then private households save. Government save. These are the savings, right? These are the sectors. No, remember our basic diagram: households, government, firms. Then household saves, government save, firm save, foreign savings. All these savings come to the financial market, banks. Then these ones will be issued to the private sector for investment purposes. Savings and investment. There's a huge, very strong correlation between savings and investment. You can then, if the country can save more, you have more money to invest. Investment increase. If private sector savings increases, banks, these savings accumulate to the financial sector, banks have more money they are more liquid, they can issue those money to the private investors. Government save, overall investment increases. Right? That's now the thing is, now the savings and in the primitive economy, first model, we didn't have banking system. Long time ago, 1950s, 1940s, 1930s, how did our people save? We didn't have savings, the media mode of savings, no banks. 1920s, so the 1900, we didn't have banks. So financial, the sector is not developed. We don't have very well developed financial sector. Then people saved at home. You know, some money, 100, 200 rupees. They saved at the kitchen. They dig a hole and put all these currencies, notes into a, close that, then keep that. These savings will not translate into investment. Savings will be there. They can't earn any interest rate. Savings there, no interest rate, no financial sector, no investment. So to generate investment, you have to have the financial intermediation. Savings coming from here, they goes to the investment. Now, still some of the problems, poor countries, the Cambodia is still the financial inclusion is very low. People don't have banking practices. People still save their money at home under the carpet. So it's a bit of a challenge. The government, they encourage people to save their funds, save their household savings with the commercial banks, right? But we don't have that issue because our financial inclusion, financial literacy is very high. Financial inclusion, more people, around 90% people have dealing with the banks. They know they have passbooks, savings book, right? So therefore they are, but the other countries, if you don't have the well-developed financial sector, so the financial literacy, what to do with their money, they don't have. Then their investment rates are very low. Banks doesn't have money. Now that's interesting. These points to be understood. In Sri Lanka, we are talking about the savings and investment because we have very well developed financial market. We have commercial bank, we have finance companies, we have the primary dealers, we have development banks. You don't have any issue, right? But well developed. Even developed country, you have so many other derivatives also, products also. You don't have that much of product, right? FDs are there. Then you have the savings account, you have the treasury bills, treasury bonds, share market. These are very limited, but the US, huge range of products, people to save their money, invest, right? Okay. Right. Okay. Savings and investment has a direct relationship. You have to have a well-developed financial sector. Now we'll go to this diagrams again. Back to what is the relationship between savings and investment. Now we said GDP, closed economy without government, households and the firms. Households consume. Household provide all the factors of production to the firms: land, labor, capital, entrepreneur. They provide, they sell. Firms produce goods, consumption goods for the household, investment good for the other companies, inter-industry companies. Then GDP is the gross domestic product. This GDP money value, all this GDP monetary value goes to the household sector, no government. If GDP value is 1,000 billion, that GDP, market value of GDP should be goes to the factors of production, owners of factors of production, households. Why? Then GDP equals Y. Y is what? Income. They are getting the income. Y equals C plus S. Households consume, save. Y equals C plus S. Firms, GDP, C plus I. Active C plus S equals C plus I. C cancel out, S equals I. It's a very important identity. What does that mean? Companies, firms invest. Investment, level of investment, value of investment is equal to the household savings only. Investments are financed using household savings. S equals I. In this model, very simple. In the closed economy, S equals I. Firms invest using household savings. That's all. If households save more, you have more funds to invest. Next one, closed economy with government. Now we have another party. GDP equals income. Let's say household income equals what? Household consume. Household pay taxes, T, to the government. Then balance is saved if there is a balance. Right? Then household provide, like earlier model, all the factors of production to they are the owners of factors of production: land, labor, capital, entrepreneurship. They are owned by the household. Household provide these services to the firms, companies. Now government also demand goods. Then firms have more responsibility, more burden. Firms will have to produce consumption goods for the households. They will have to produce goods and services for the government, G. Then again they will have to produce investment goods for the other companies, inter-industry. Then GDP equals what? C plus I plus G. This side. Other side, because all the income goes to the households. Household consume, C. Household pay taxes, T. Household save, C plus T plus S plus T. At equilibrium, same. They equal C plus I plus G equals C plus S plus T. Then what will happen? I equals S. C cancel out from both sides of these equations. Then if you take G to the right hand side of the equation, T minus G. I equals what? S plus T minus G. What is S? Household savings. What is T minus G? T is the government tax revenue. G is the government expenditure. Then T minus G is the government savings. T minus G is the government savings. You can take down the government savings. Now we are two players in this model. Private sector saves, government saves. And investment, all the savings go to the financial sector. Investment have more flexibility, more funds. Funds coming from the private sector saving, funds coming from the government saving. Investment equals S plus T minus T. Investment equals private savings plus T minus T, government savings. But the thing is, now in Sri Lankan case, government does not save. T minus G is negative, minus, deficit. Then problem. Private sector save 1,000 rupees. Private sector save S equal 1,000 rupees, let's say. Government is save, let's say, the 100 rupees. Then what will happen? Total savings 1,000 minus 100, 900. Investment will be 900. When government is save 100 rupees, private sector savings 1,000 minus 100 is the investment 900. See, private sector save 1,000, but the overall investment in the economy is 900. Private sector deposit 1,000 rupees in the banks, but the investors are getting 900. What is the reason? Government is save. Government does not save. Government the savings is 100 minus. So therefore, in this economy, if both saves, if private sector save 1,000, government save 100, private investment will be 1,000 plus 100, 1,100. But what happened? The real problem is private sector saves, government is saved. Then private investment less than the private savings. Private sector generates savings, but because of the government is savings, overall investment will go down less than the private sector savings. Right. Final model. Open economy. Savings investment. Now we have another player. First model, we didn't have government, only one payer. Savings coming from only the households. Second model, we have two players. Savings coming from private households and the government savings. So the investment is financed using private savings and the government savings. I discussed one extreme case when government is saved. Third model, we have three players: private household, government sector, foreign sector, export and imports, M-X, XM, savings, government savings, and the M-X. Let's write down these identities. Y equals, now we can understand. Y is a income generated to the household. Still, household own factors of production. All the income should go to the household. Household income is equal to what? They consume. Domestically produced goods. Then taxes, they pay taxes. Households. Then they demand imported goods. We buy shoes, we buy the household buy three-wheelers, household buy televisions, household buy the vehicles, mobiles, right? Then they are imported goods. Demand for imported goods. The C is the domestically produced goods. Now in a consumption basket, we have domestically produced goods and the imported goods. 40 to 50% of our basket, the goods and services may be coming from imports, imported goods. Then what will happen? Y equal C plus M plus T plus S. Balance is saved. GNP. Now I have said earlier, I said GDP, now GNP. Why is that? With GNP is you have foreign sector, XM. GNP equals C plus C for the consumption goods for the household, G for the government expenditure, government demand goods and services, X these firms will have to get the exports also, produce exports, exported goods, then investment goods for the other firms. At equilibrium, they equal. GNP equals the Y. C cancel out. Take G to the right hand side, T minus G. Take X to the right hand side, M minus X. Left hand side, you have only I. C cancel out both sides. Now what will happen? In an open economy, the total investment is financed by the savings of these three players. Who are the players? Private households, government sector savings, foreign sector savings, M minus X, imports, imported goods, exported goods, goods flow. Imported goods, we import machinery and equipment, cement, iron bars, other imported goods, then minus exports. And it's also savings, foreign savings, household savings, government savings, foreign savings. The minus X numbers are coming from the balance of payment statistics. T minus G is coming from the government budget. Number 12, you can get those numbers. Then savings is the private savings, right? Private savings, we don't have any estimate of private savings, but we can calculate. If you know the investment value, total investment in the economy, government savings in the economy, foreign savings in the economy, you can calculate private household savings, how much, using this formula. Right. This is the expenditure approach, GDP. Income approach, I didn't discuss, but the income approach is again can be calculated using GDP, can be calculated using incomes. What are these? Total wage bill of the private sector. They are coming to the income. Your wages, if you take the household, wage income, FD interest income. If you have invested in treasury bill interest income. Then if you have some shares in the stock market, your capital gain coming from this one. Then all the income sources, if you take household, similarly, to generalize this for the entire country, wage income, wages, profits, all the factor income coming to the households. What are the factor income? Wages coming for the labor you sell. Then the profits coming for the entrepreneurial skills you sell to the firms. Profits. Then the interest rates, you have the capital coming for the capital, the services rendered by the household, owned by household. I. Then the depreciation also added. W plus, R plus, profit plus, P plus, depreciation is the component of the income approach. But here I have not discussed. We discuss mainly production approach and the income approach. Please go through my slides and understand the concept. There are lots of concepts, but slowly learn these concepts, and with the central bank annual report, you can understand all these numbers. Right. Okay. Now we will go to the next slide. Right. Introduction to textbook models. Now this is a bit funny topic as it says, but to explain the economic performance, country's economy, we have different models in the economy. Different models. Different model. What is a model? Model, as I said, it's like a roadmap, right? So model explains. It's an approximation to the reality, actual behavior of the economic forces. Using three basic models, economists try to explain the economic performance. ISLM model, aggregate demand, aggregate supply model, national income model, GDP model. National income model is one model using calculating economic growth rate, GDP deflator, share of contribution coming from each sector, agriculture sector growth rate, industrial sector growth rate, like that. Sectoral growth rate, you have 48 sectors now. You can explain the direction of the development forces. Again, you have another model called ISLM. We have separate lecture. ISLM model I might discuss at the end of this lesson. Investment savings and the money market and the goods market equilibrium is explained by the IS and LM. Using that also, you can understand the economy. Interest rate, financial sector is there. GDP and the interest rate is linked in this ISLM model. Third model, aggregate demand and the aggregate supply model. Okay. The role of a model, what is a model? Is to enable the economists to isolate the principal relationship between economic variables and to explore the logical consequences of changing those relationships. Why is that? Why it is important? Then you can understand the direction of movements, in which direction economy is going. For example, we said our GDP growth rate is negative. Per capita income is falling. So what conclusion you can make? Our economy is shrinking. Growth rate is negative. People's cost of living increases. Living standard deteriorate. Like that. You can just say something about this using model, using national income model. Economists in general use three basic models to structure their thoughts about the economy and to study the impact of economic policies on the economy. Now, these models are important. Two reasons. Number one, as I said, you can discuss the direction, which way our economy is moving. It is developing, if it is shrinking, or it is stagnated, will there be high inflation? You can analyze. Using this model, you can analyze the economic movements. Number two, next one is that if you know this model, using this model, you can design various policies, economic policies. If you want to encourage investment in the economy, if you see from this model, you see investment is, you want to encourage investment. Then you go to the monetary policy. Then use the monetary policy so that central bank can issue this cut the interest rates, policy rate. Then banks also cut their lending rates. Investment increase. Policies can be determined using these models. Impact of economic policies on the economy. Policies can be decided. First, direction can be studied. Policies can be decided. Model 1, the expenditure system. This is a very familiar system. This consists of national income identity and a number of equations determining various component of national income. Yes, we have done 11:30. Second model, as I said, ISLM model. This model develops the schedule for equilibrium in the goods market and the money market. Second model combine real sector with the market sector. Right? First model only real sector. C plus, I plus, G plus, X minus M. Remember earlier formula? ISLM model, I have a lecture at the end of this session. I have ISLM model discussion. The IS curve represents the goods market equilibrium. LM curve represents the money market equilibrium. For example, let's say microeconomic demand and supply. Demand curve shows the consumer's behavior. Supply curve shows the firm's behavior. Interaction between these two shows the equilibrium. Consumer's behavior and the firm's behavior same. Consistent. Both are happy. Similarly, IS curve is downward sloping curve. It represents the goods market equilibrium. LM curve is upward sloping curve. It represents the money market equilibrium. At the point of intersection, we can say general equilibrium. Both goods market and the money market is in equilibrium. You can calculate what interest rate and what GDP level they are in equilibrium. Aggregate interest rate, average interest rate, and average the GDP. ISLM, the model developed schedule for equilibrium in the goods market and the money market. IS schedule is derived from the above model 1, but differs in the investment spending is yes. I'll discuss this again here. Then a goods market, Y equals C plus I, investment function is there. That is using that we derive the IS curve. Money market, monetary sector, demand for money and the supply of money. Using that, we explain the good money market equilibrium. I think I have a separate lesson for this one. Right? Briefly, it's a curve. The curve, IS curve downward sloping, LM curve upward sloping. IS curve represents the goods market equilibrium. Interest rate and GDP, so that goods market is in equilibrium. Interest rate and GDP, why? So that money market is in equilibrium combination. At equilibrium, at the point of intersection, both goods market and the money market are equilibrium. That is called general equilibrium. Economy, both goods market and the money market equilibrium. This, we can have some equilibrium interest rate and equilibrium GDP level. Third model, aggregate demand and supply. Aggregate demand is overall demand for all the goods and services in the economy. And it depends on the price level in the economy. So the income and price is the two axis, price level and the income. Earlier, aggregate demand, what are the x-axis? GDP, y-axis, price level, price. ISLM, x-axis, GDP, y, and the interest rate, y-axis. IS curve, downward sloping, LM curve, upward sloping. Aggregate demand curve, downward sloping, aggregate supply curve, upward sloping. It is like normal, if you take demand for rice, demand curve is downward sloping, supply curve is upward sloping. Demand for fish, the quantity demanded and the price, demand curve downward sloping, supply curve upward sloping. Now, what is the difference between this small markets and this one? This is aggregate demand. So, economy-wide concept, aggregate demand and aggregate supply. There are a large number of markets, players, demand side. There are millions of suppliers, the IS supply. So the aggregate demand and aggregate supply. The price is the key, price level, key factor, right? Right. Now we will discuss the first model, model 1. System, model 2 ISLM. At the moment we are not going to discuss these two models. At the moment we are not going to discuss the model 3 ADAS model. ADAS model, ISLM model, expenditure model. Expenditure model, ISLM model, ADAS model. Now these three models can be used. Economists use these three models to explain, understand, describe the economic development, progress of any given economy, and these three models can be used to design the policies also, economic policies. When you say economic policies, two types of economic policies: monetary policy and the fiscal policy. Monetary policies are determined by the central bank, the central bank baby. Fiscal policies are determined by the treasury, Ministry of Finance. What is fiscal policy instruments? Taxes, government expenditure, government revenue, financing of the budget deficit, sources of the borrowings. That is monetary fiscal policy instruments. From the taxes, from the budget speech, Finance Minister, Honorable Finance Minister design. This year we are going to reduce taxes or increase taxes. This year we are going to cut increase the expenditure on highways, right? This year we are going to build the 1,000 schools, like that. Policies that relate to the government expenditure and revenue. Expenditure, revenue, deficit, policies related to expenditure, revenue, and the deficit financing. The fiscal policy. Monetary policy decided by central bank. Interest rate policy. Policy interest rate, repo rate, reverse repo rate, bank rate, then the reserve ratio, all these things. Rates, interest rates coming under the control of the central bank. Central bank, 2 weeks time, bi-weekly, central bank decide the monetary policy, the interest rate movement, whether to increase, decrease the policy rate, repo rate, reverse repo rate, increase, decrease the reverse reserve ratio, increase, decrease the bank rate. Central bank doesn't ask the commercial banks to increase or decrease your lending rate, increase or decrease your savings rate. No. Central bank could control, could manipulate, could change the levels of interest rate coming under their purview. What are the interest rate? Repo rate, reverse repo rate, reserve ratio, bank rate. When they do these changes, that there's a transmission mechanism. This will reflect, this will transmit to the banking sector. This will be the signal to the banks. Banks then, so that bank change their interest rate. Change their interest rate, right? Right. Model 1. Now we are going to discuss the model 1, right? Model 1 is right. Closed economy without government. Model 1. Model 1 is explained using 3 structures of an economy. Now we can understand these models. You are familiar. Closed economy without government. Households, firms. Then you have GDP equals C plus I. Closed economy with government, with lump sum taxes. GDP equals C plus I plus G. Tax system is lump sum. I will explain that. Then closed economy with government with, that is not lump sum. This is called proportionate taxes. Please cut this. Proportionate taxes. Both are lump sum. I'm sorry, that's a typo. First one is lump sum. This one is proportionate taxes. Third model, open economy. Households, firms, government sector, foreign sector, exports and import sector. For these 3 models, we are going to discuss how to calculate GDP mathematically in this model. Simple model is a closed economy without government. Very easy to calculate the GDP. You want to calculate GDP, right? What is GDP? GDP equals C plus I. GDP equals C plus I. Why is that? GDP coming from the business sector, firm sector. Firms produce consumption goods for the household. Gross domestic product, no? Consumption goods production for the household. Then firms produce investment good for the other companies, other firms. So therefore, gross domestic product equals C plus I. That is right. But what is C? What is I? Consumption function and investment. Investment, let's say in the economy, investment level is 50. Exogenous, constant. At the moment, the time being, we will assume that the investment is 50. Consumption depends on what? Consumption function. Consumption is a function of income. Why? When income increases, we consume more. That's a positive relationship between consumption and income. When income decreases, we cut down our consumption. When income increases, we increase our consumption. Positive relationship between consumption and income. Using that, we can write down the consumption function. I have written down the consumption function. For example, we have some meanings. 50 plus 0.8y. Consumption function is 50 plus 0.8y. This 0.8 is called, take down, marginal propensity to consume, MPC. 0.8 is called marginal propensity to consume, MPC. 50 is called autonomous consumption. Autonomous consumption. 50 is called, or C1 is called autonomous consumption. C, small c is called marginal propensity to consume, MPC. Then you have the consumption function. Then Y equals GDP equals Y at equilibrium. We want to calculate GDP or the income. Y. C plus I. 50 plus 0.8 Y plus 50. Investment is 50, no? You substitute. Then 50 plus 50 is 100. 0.8 Y equals Y. Then if you take 0.8 Y to the left-hand side of the equation, Y minus 0.8 Y equals 0.2 Y. Right-hand side, we have only 50 plus 50, 100. Y equals 100 divided by 0.2. 100 divided by 0.2 is what? 500. For this model, GDP is 500. This 500 goes to the, translate as an income to the household, 500. Understand? 500. 500 comes to the GDP is 500. This goes to the 500. Then what will happen? We know investment 50. Investment savings 50. 50, 50. Then this 500, 450 is the consumption. Plus 50. 50 the investment. No? Consumption. You can calculate investment 50. I have given investment 50. Investment equals savings for this one. I equal savings 50, 50. You are getting 500. Therefore, what is C? C equal 500 minus 50, 450. Consumption expenditure is 450. Like the calculation, this is how we mathematically calculate GDP or income. First, you write down the identity. Y equals C plus I or GDP equals C plus I. Then you substitute. I, 50. Consumption. C plus CY. C1 plus CY. 50 plus 0.8Y. Consumption function. It's a very simple consumption function. Because a very simple consumption function because we don't have government. Close no import-export trade. That's why our consumption depends on income only. That's why this simple consumption function. When you simplify, you get 500. right? Now, suppose investment increases to 60. What is the new equilibrium income? Earlier 50. Consumption function 50 plus 0.81. Now what have happened? Investment increases to 60. Consumption same function. Can you calculate? Please calculate then. The answer is there, but I want to calculate. Y equals C plus I, substitute and get this 550. I'll give you 5 minutes to understand this. Calculate. Prove that it is 550. Yes. Y equal C plus I. Please calculate. Investment now it is not 50, 60. Investment increases by 10 billions, 50 to 60. Now let's see what will happen to GDP. Will GDP increase by 10 billion or more than that? Earlier, investment 50, C 50 plus 0.81. Now, consumption 50 plus 0.8, Y, investment 60. What is GDP? GDP equals 50 plus 0.8, Y plus 60. This time, 50 plus 60 is 110. 0.85 same. Then Y minus 0.8, Y is 0.21 equals 100. Then Y equals what? 110. I'm sorry, this is not, I'm sorry, I have done so many mistakes. Please cut this. This is not 100, 110. 110 divided by 0.2. 110 divided by 0.2. 110 divided by 0.2. Let me check. 110 divided by 0.2 is 550. 550. Because please cut this and change that 110. This should be 110. With this 110. Then it is 550. Let's see what will happen. Except investment, all other things same in the economy. Same consumption function. We assume companies increase their investment from 50 to 60. 10 billion. 50 to 60. What is GDP? GDP increases from 500 to 550. 50 billion. Investment shock. Investment increase only by 10 billion. But GDP increased by 50. 5 times the investment increase. So now we are going to introduce a new concept called multiplier. The investment increased by 10 billion. In GDP increased by 50 billion. 50 change in GDP 50 divided by change in investment 10. 50 divided by 10 is 5. Multiplier. This economist multiplier is 5. What is the value of the multiplier? Multiplier is change in Y divided by change in I. 550 minus 500 divided by 60 minus 50. 50 divided by 10 multiplies 5. What do you mean by the multiplier? What does that mean? If you, for this particular example, we can say if you increase by investment by 10 billion, GDP increased by 5 times that. That's a very interesting thing. If you want to increase GDP by 50 billion, you don't need to increase investment by 50, only 10. It will generate multiply by 50. That is very interesting because we need a small shock, investment growth. You can give a small growth, small shock to the country's investment level. You can get very high result impact on GDP according to this model. Multiply. If multiply is, let's say 10, what does that mean? If investment increased by 1 billion, GDP increased by 10 billion. Multiply is 5. If investment increased by 1 billion, GDP will increase by 5 billion. If investment increased by 10 billion, GDP will increase by 50 billion. That is very interesting. But again, you can understand analyze this multiplier in the context of current situation. What will happen? Current situation, investment is not growing. Investment level is falling. Then what will happen? If investment goes down by 10, GDP will go down by 50. That is the danger. It works both sides. If investment increases by 10, GDP will increase by 50. We all are happy. So we think, okay, very small shock to the investment will generate a huge growth in the GDP. But same thing applicable to other side. If investment goes by 10 billion, economic GDP will go by 50 billion. That is the danger. That is the problem. If you know the multiplier, you can analyze the economy. Understand? Closed economy without government. Please go through. These are very simple mathematics. Now still we are discussing first model. Right. Now savings in this economy. What will happen? Well, I calculated that now. Y equals C plus S. Y equals C plus S. Income C plus S. S equals Y minus C. Right? Y is 500. C, we can calculate 50 plus 0.8 Y. 50 plus 0.8 Y 500. Answer is 450. So the consumption is 450. Consumption 450. Household consumption 450. Income 500. Therefore, savings how much? 500 is income. 450 is the consumption. Expenditure balance is savings is 50. Investment 50. Because I use the way around. We know investment is in this model 50. Therefore, we have proved no saving should be 50 no. 50-50. Then consumption 450. But in this question, they have calculated. We have calculated the other way around. First, you calculate consumption. How do you calculate consumption? You know the Y 500. Take this Y 500 and substitute that to the consumption function. 50 plus 0.8 Y 500. 0.8 Y is 400 plus 50, 450. Income from this side 500. Household consume and save. Consumption 450, therefore savings 50. This savings, remember in this model, savings equal investment 50. No government, only plays the private sector. Savings equal 50. Investment equal 50. Economy is balance. GDP 500. Savings 50. Consumption 450. GDP 500. From the equation we calculated 500. Then consumption 450. Balance is saved 50. This savings will be equal to the investment 50. Correct. Next model, closed economy with government. Now, if you can understand the first model, you can easily understand the second model. But when there is a government, government tax people. Then you have to ask the question before you do the calculation, what kind of tax system this country has? There are various tax systems. Number one, lump sum taxes. Lump sum taxes mean irrespective of your income, whether you are getting 1 million or 100,000, 200,000, 100,000, or 500,000, only 50,000. Irrespective of this income of your company, of the household, government gets some fixed value as a tax. Let's say 5,000. 5,000, everybody has to pay, taxpayers in the tax bracket should pay 5,000. Whether you rich or poor, 5,000, 5,000, 5,000. Rich company or the poor company, 5,000. Right? For example, petroleum corporation pay taxes to the government. Huge journey. They also maybe under lump sum tax 5,000. Then electricity board pay taxes to the government 5,000. Lump sum taxation. Other type of tax system is proportional tax system. Proportional. Proportional mean proportionately poor people pay less compared to the rich people. Proportionately rich people, high income people pay more. Your tax level, tax income depends on your income. If tax rate may be at the 0.3, income is 1,000, 0.3 times 1,000 is paid by the poor people. Tax rate is 0.3, income is 5,000. 0.3 into 5,000 paid by the rich people. So proportionately, you are paying more to the government. Right? As your when your income increases, government tax rate also proportionately increases. That is the closed economy with government. Then, first case we assume lump sum taxes or the no taxes, without taxes. Right? So 3 cases: without tax, with lump sum tax, with proportional tax. Without tax is out. Why is that? Any government in the world cannot survive without taxes. Tax is their main revenue. Tax is the oxygen for the government. No other activities. Government as a unit is very lazy. Tax revenue, taxes are the oxygen to the government. If government say, no, we don't want taxes, that means government is dead. So we are going to discuss 3 cases. Without tax, extremely unrealistic case. If there is no taxes, you cannot have a government. Second case, lump sum taxes. Third case, proportional taxes. In Sri Lanka, we don't have lump sum taxes. We have the proportional tax system, regressive tax system. Right. Then, when we introduce the government into the model, government does not tax. T0, no taxes. Very unrealistic. Can't help, because just to understand this model we use, and I think second case we have this the proportional taxes, right? Okay. Right. Without taxes. C equals GDP equals C plus I plus G. C equals C1 plus CY, 50 plus 0.8Y. No taxes. When you tax, when the government tax people, your income is not Y minus T. Disposable income is less than the income. If government tax 5,000 rupees, suppose you are getting 20,000. For consumption, how much you have? 20,000 minus 5,000, you have 50,000, 15,000. Disposable income decreases when you have taxes. But in this particular case, no taxes, no. You can maintain, you have 20,000, you have the 20,000, no taxes. Your income is Y, you can use Y in the function. C equals 50 plus 0.8Y. I equal, assume 50. Assume government expenditure 10. Substitute. Y equals or GDP equals C plus I plus G. Please work out this the example. Answer is there, but I want to work out. Please work out that. GDP equals C plus I plus G. 50 plus 0.8. Y is the C. Investment how much? 50. G how much? 10. Then you add numbers. 50 plus 50, 100. 100 plus 10 is 110. 0.8 Y. Y. Then if you take 0.8 Y to the left hand side of the equation, Y minus 0.8 Y is 0.2 Y equals 110. Y equals 550. In this model, GDP for the income is 550. GDP 550, that is goes to the income at the 550. Investment 50, savings also 50. You can calculate, no taxes. Then you can calculate consumption expenditure, right? 450. 550, then 500 will be the because the 550 the GDP or the income, savings 50, it is equal to investment. Then consumption expenditure will be the 450, no taxes, no taxes, T zero. Then 500 minus 50 is the 450 is the, oh sorry, 550 minus 50 is the 500. Consumption expenditure 500, savings 50, total income 550. That's how we the interpret this. You can calculate. You can show that the second model, closed economy with government. Closed economy with government, right? Closed economy with government. Now tax system we assume proportional taxes. T equals, now what will happen? There is an interesting case. The moment you introduce the tax system, proportional of the lump sum, your income is not Y, YD. This is called disposable income. Vehicle haki adayam. Disposable income. What is disposable income? Your income minus tax, Y minus T. Y minus T, let's assume T equal TY. Proportionally, you can say tax rate is 10% of Y. So you have to pay 10% your income to tax to the government. Companies will have to pay 10% of their income to the government. If you earn the 50,000 rupees, 50,000 rupees into 10% is 5,000 to the government. 15 to 10,000 is yes, 5,000 to the goes to the government. Your income 50,000, taxes TY. 50,000 into 10%, 5,000. Then what will happen to your disposable income? 50,000 minus 5,000. If they don't have taxes, you have income of 50,000 for the consumption. Now we have income only 50,000 minus 5,000, only 45,000 for the consumption. That case, consumption depends on YD. You cannot use all 50,000. You can use maximum only of 45,000. YD equals Y minus T. YD is called disposable income. Vehicle haki adayam. Disposable income. T equals TY. Where is tax system is now proportional taxes. 10% of your income is tax, TY. I equals 50, G equals 10. I have given this left hand corner, I have given all the numbers. The T equals TY, T is 10%, G 10, I 50. But in the idea is to calculate Y or GDP. How do you calculate? Go to the equation. C plus I plus G. I 50, G 10. Okay. Now C. C is what? 50 plus 0.8 YD. YD is what? Y minus T. 0.1 Y. 10% of your income, 0.1 Y. 10%. If it is 20%, 0.2 Y. 30%, 0.3 Y. Y minus 0.3 Y. Because the tax rate is T is TY. 0.1 Y, 0.2 Y, 0.3 Y. You can calculate that, you deduct from the income, nominal income, to get the disposable income. Understand the calculation? I plus G, no problem, no issue. It's plus 10. But here you have a bit of a problem calculating disposable income. How do you calculate? Y minus TY. Y minus 0.1 Y. Now we substitute 50 plus 0.8, YD is Y minus 0.1 Y, plus 50 investment, plus G government expenditure. Simplify. 50 plus 50, 100, 100 plus 10, 110. Simplify the bracket, expand the bracket, 0.8 Y minus 0.8 into 0.1 is 0.08 Y. If you take all Y terms to the left-hand side of the equation, what will happen? Y minus 0.8 Y plus 0.08 Y. Also would be 0.28 Y will be equal to 110. Y equals what? 392.22. 392.22. Right? Remember, if there was no earlier case, if there are no taxes, GDP was 550. Now with the taxes, GDP was 392. Why that? Some of this the income of the household going down to the goes to this the government taxes. When you tax people, people's disposable income decreases. Disposable income decreases. Right? That is the reason to drop in this Y. We have the closed economy with government, GDP with taxes. With taxes, the moment you introduce taxes, people's disposable income decreases. As a result, overall GDP decreases. 392.22. If you compare no tax regime and with tax regime, right? With tax means when the government taxes, disposable income decreases. Household consumption level decreases. Then GDP decreases. 550 to 392. Right? In the government tax. But the other argument is this tax revenue goes to the government, and government can use those tax money to increase their investment. Economic activities will link, overall GDP might decrease, but the government can use tax revenue to enhance the economic activities. More highways, more schools, more buildings, like that. Open economy. GNP equals what? C plus I plus G plus X. C plus I plus G plus X. Income. What do households do with their income? First, consume. Then, you have to pay taxes. You can't say no. Then third, you buy imported goods. M. If there is a balance, you save. So income, there are four components. Y equals C plus T plus M plus S. GNP equals C plus I plus G plus X. 4. Firms produce consumption good for the domestic domestically produced goods, C for the households, G for the government, X is produce exporters, firms produce investment for the other firms. Now this is the full model. Y equals GDP or GNP equals C plus I plus G plus X minus M. Open economic model. What is the identity? C plus I plus G plus X minus M. Now we write down the component. Consumption function is C1 CYD. YD disposable income. What is disposable income? Nominal income minus taxes. Y minus T. What is tax equation? TY. T is the tax rate, marginal tax rate, you can see. Tax rate is 10%. Then they have given that model I equal 50. These are given numbers, right? You can change these numbers and we can have different answers. Government expenditure 10. Tax rate 10%. Tax rate. Exports 50. Imports, again there's another equation. Our imports, M depends on demand for imported goods depends on our GDP. M is a function of income. That's why they have written imported goods is 0.05 Y. When GDP increases, when people are getting richer and richer, you by your income going to the imports also increases. Domestically produced goods C. When income increases, imports increases. 0.05 Y. When income increases, you import more and more goods and services. Sometimes you might be buying the branded shirts, branded goods, pair of shoes, Nike. Like that, you spend more. The branded items are expensive, relatively expensive than the other items, normal items. Now understand this model. Consumption function. Investment is constant 50. Government expenditure constant 10. Exports 50. Imports depends on income. But substitute now. Very carefully, I want to substitute these numbers. I have given all these, the model, the left-hand side of the equation, you have the model. C, 50 plus 0.8, Y minus 0.1 Y, TY. 10% of tax rate. Then I, 50. G, 10. X, 50. M, minus 0.05 Y. Imported goods. Then you simplify. By simplify, you can get 50 plus 100 plus 10 is 110, 110 plus 50 is 160. Y terms again you can simplify. 0.8Y, 0.08Y, 0.05Y. Simplify and get all these Y terms to the right hand side of the equation. Y minus, simplify this thing. Then you get 0.33Y equals 160. Y equals 480. Income equals 480. 480. 480. Right? Two reasons. Why is that? When you import more and more, imports means our GDP decreases, X minus M, no? Money going out of the country, resources going out of the country, X minus M, GDP decreases. Earlier model, we didn't have that. Now, this model, tax system also, there's some draining out of income. This, that's why this income decreases to 480. Purely, when you import, our domestic resources, our money going out of the country and go to Japan, Japanese importers, US, the Japanese sellers or US sellers, Indian sellers, right? So our GDP will be low. But I have proved that. Okay, I have proved that. Earlier we discussed the same thing is proved. Okay. I have proved that. Please understand these diagrams and the calculation. Please go through this calculation carefully. If you have any question, ask me. Right? Before I go to the next lesson, if you have need more clarification, please ask me. So please ask me. First, I want you to go through this calculation. Do that by yourself and understand. If any question, please ask me. That is the first model. We discuss calculation, first model. Second model we don't have. We calculated. ISLM I will discuss at the end of the session. ADS model at the end of the session, because we need knowledge about financial sector also. The money supply, determinant of money supply, like that. Right. I think you all can see me. If you can't see me, please tell me, otherwise we'll have problem. Right. Now we will go to the next. Budget. Macroeconomic and national income account we discuss. Remember, other one is public finance. So the budget and the budgetary policy. We are going to discuss budget and budget in simple terms. We are going to discuss what is budget, who compile budget, what are the main components of the budget, how does the government finance the budget deficit, what are the sources, what are the consequences of each source, like that. We are going to discuss. Right? Everyone have a theme, vision statement, right? Vision statement is there. Now this year we don't know what will be the vision statement of the government budget. They might say the various vision statement, right? Could be there, right? Way out, escaping, going out from COVID, like that, right? New normal, the economy, like that. That's a vision statement. Your whole budget is structured with this vision statement. Okay, now let's see the first few diagrams. That is the 1223 years. This is our circulation of macroeconomics. 4 sectors: household, government, firms, and the foreign sector. 4 sectors: markets, labor market, financial market, goods market. Right? Forces: labor demand, labor supply. Then economic activities: transfers, taxes, savings, investment, imports, exports, transactions. These are transactions. All the savings coming to the financial market. Firms savings coming to the financial market. Government savings again to the financial market. Household savings, financial market. Foreign savings coming to the financial market. Financial market, there are different players. Commercial banks, treasury bill, treasury bond market, then finance companies, development banks, leasing companies, insurance companies, all are there. financial market, all the savings coming. That's why I said in open economy, investment is equal to what? Household savings, government savings, foreign savings, right? The household saving, then the company savings also there, right? That is the main structure of the open economy. What is the government budget? First question. First, we'll analyze this budget. In Sri Lankan case, budget will be coming on November 12th. Usually, budget day was November 6th, November 12th. The budget of the government is a planned, underline, planned estimate the revenue and of the government expenditure for a given year, together with the financing plan on how a deficit is financed or a surplus is utilized. Long statement, right? Two things: planned estimate of the revenue. Now this 2021 November 12th budget is presented for the coming year, 2022. How much does the government expect as the revenue? Government revenue. How much does they expect? Do they spend? Total government expenditure. So as a result, what would be the budget deficit or surplus? Then, when there's a budget deficit, you have to show the way, sources of financing. How are they going to finance this budget deficit? Are you borrowing from the IMF or the foreign government? Then the domestic borrowings, EPF, ETF, insurance companies like that, bank borrowings. So the revenue, expenditure, deficit, financing of deficit for the coming year, next year. So the coming year, then you can have some budget proposals to finance budget deficit. Your government finance minister might say, we are going to increase the tax rate from VAT rate from 8% to 12%. This government at the beginning, what they do, when they came to power, they reduced the tax value-added tax rate, VAT rate, from 12% to 8%. Nobody asked, but they did that. Now, government revenue has gone down because of the tax revisions. Taxes on sugar, taxes on cutting, taxes on the VAT, value-added tax, around 600 billion. Your tax revenue has gone down by 650 billion. That is the issue. We have a huge deficit. These are the problems in formulating, reading the, compiling the budget, government budget, right? So I will stop at this point. What is the government budget? Please, I want to read this, all the other slides. Government budget. Then I discuss the theme of the budget of the previous budget, one of the themes. Then policies. Then we will discuss institutions, complete the budget, fiscal policy, monetary policy, financial budget, taxes, direct taxes, indirect taxes, consequences. Then we address some of these issues. Sometimes people say our tax rate is very low, we should increase the tax rate, right? Then what are the problems? Can we do that? Next week, we will see Saturday morning. Discuss this and I might start the BOP. Yes, right? BOP, right? Okay. Thank you very much.